So with that, let's go ahead and switch back to our California teammate, Mr. McManus. How you doing out there?
Good. Yeah, I think you can hear me okay. I'm always worried about this microphone situation. But yeah, I've gone out on a limb and finally picked a bank. I've actually been buying Bank of America for a while on a Zeco account, and it's interesting. Banks are still a mess. I mean, they're still getting their balance sheets fixed, and they're still recovering from their demonstration that their primary business, which is lending at one rate and borrowing the money from consumers and paying a lower rate, that they actually weren't too good at doing that for the last couple of years. But they're getting back. And it's interesting, actually, when you go on to Manifest Investing and look at all the banks, um, they're all, by and large, in pretty sorry state. There's none of them close to a quality rating of 80, but there are a few that are pretty up there. Um, Bank of America isn't one of them. Its quality rating is close to 50, but when you compare it against the other behemoths in the industry, say Morgan Stanley or Citi, it's significantly higher than them. And I would also argue that 49.5, while it's not a good number, when you're a factor of two or three higher in quality than, say, oh, I don't know, the National Bank of Greece or Allied Irish Bank, you're definitely not at the bottom or even close to it. The projected growth rate of this bank going forward is about 9.5 to 10%. Some analysts have it higher. And the thing that actually attracted me to Bank of America is over the last year and a half, when I've been trying to project what its earnings might be, I've always been on the low side, and significantly on the low side. It burst through those numbers pretty aggressively. As I said, the company hasn't performed well recently, and the latest scare with not being able to track where the paper is, their mortgages, their lifeblood, that's a bad sign. But all banks are kind of in that little bit of a mess. But that will fix. And it is a leading bank, but it's not yet a bleeding bank. I mean, it's not the worst of the bunch. But the attraction to this bank, to me also, is that its stock price has really plummeted in the last 12 months. And while there are banks with slightly higher quality, I mean, you can look at banks like Mellon or Wells Fargo, particularly, is a very sound-looking bank. It's priced significantly or somewhat higher, I think, than is Bank of America. So I think there's more upside here. Banks actually are improving their balance sheet, and I've alluded to that before. Their drawdown issue, or their issue of tidying things up and making them neater, is improving. And that actually is hurting the economy in the short run, as I pointed out earlier, as credit becomes less available and standards are increased. But in the long term, obviously, it's a good thing that banks get their act in order and get everything tidied up. Credit quality of the bank is improving. It has very good gross margins, better than some of its industry peers, and its revenues are growing pretty aggressively. It's changing its revenue mix. I mean, in the past, it was pretty aggressive at gathering fees from consumers, whether they be at ATM machines and things like this. It got a lot of pushback from consumers about that. So it is actually changing how it generates revenues from consumers, making it more transactional based in the account rather than nickel and diming them at ATMs. And while that in the short term has hurt earnings, I think for the long term, keeping consumers happy is the way to success really in any industry. Expenses are still high and a little bit higher than peers, but they are hacking through those pretty aggressively. And with all banks, all of those ratios that you look at for health and well-being in any company, they're all improving, but they're improving right across the industry. But Bank of America isn't really different than its peers in that regard. So we move on. I'm going to keep this short because I really kind of hogged a lot of time, more than I'd planned to right at the get-go.
Not a
But
problem.
as the economy improves, banks clearly will too. And this is a money-centered bank with a lot of leverage in the brokerage industry as well, thanks to the acquisition of Merrill Lynch. I'm not too sure how well that integration is going. It still seems to be functioning as an independent entity to some extent. I've gone into Bank of America recently to see if they're cross-promoting their services, if they're cross-promoting Merrill Lynch, but I really haven't seen any super aggressive push in that area. And then the other thing that you always get asked about when you talk about banks is this regulatory reform act that was passed soon and the uncertainty that surrounds that, because really it's a government official that will really set the rules rather than Congress, and that's probably the place it should be done, as there will be industry input into that. But the fact is that, and I think Mark talked about this earlier when he talked about McDonald's, as long as there's a level playing field, if everyone is singing from the same hymn book, it doesn't really matter if there is regulatory reform, I mean, unless it's kind of wacky, but that generally doesn't really happen. But everyone is going to really have to face the same economic environment, and so the stronger players will do better. And the fact is that all banks are grotesquely depressed right now, and as the economy recovers, they will too. So let's move on.
Okay. Well, thanks.
Well, I just put the SSG in there, but I'll just skip over that.
Yeah, the SSG is kind of a nightmare, and one of the things I thought I might do, just to reinforce for just a minute. Some of you are very familiar with a different convention that we have at Manifest for dealing with financial services companies, and I just wanted to take a minute just to mention that, you know, here is an SSG where we have basically substituted book value for sales. We don't attempt to calculate the revenues, we use book value. And then, so the top line here is the book value. The bottom line is the earnings per share. So literally, the difference between those two lines, literally, is the return on equity. And it actually becomes a very handy way to analyze some of these companies. Just a couple other points that I would make with the difficulty or challenge of analyzing a company like Bank of America, and this ties in with what Hugh had to say earlier. You know, the design of the stock selection guide going back almost 50, 60 years, the attempt or the intent was that at least a couple of recessions would be reflected in the 10-year historical period for any company. And this becomes brutally important for companies which are economically sensitive or cyclical. And all the financial companies certainly fit that bill. So in this case, you really almost need to take a look at more years of history when it comes to book value for a company like Bank of America. You can see the recession there around 2008, 2009. But in order to really come up with a long-term growth trend, you probably need more years. And the software is really not capable of providing that. And it's something that you need to really take a look at, or at least factor into your thinking when it comes to a company like Bank of America. We'll cover this comprehensively in a separate workshop here shortly. But you know, some of you would be sitting out there saying, well, why don't you just make 2009 an outlier? My attitude on outliers is when you do that, you're pretending it didn't happen. And Hugh and I have had many discussions about this. It happened. I mean, it's part of the long-term picture for this company. And as I said before, you know, as you form growth expectations for a company like Bank of America, you really have to look at a longer-term trend. You have to look at longer-term general growth of population and generally return on investments, because they have such large investment portfolios. So it's just a whole different look, probably one that deserves another an hour all by itself, and we'll do that. But in this case, Hugh is actually taking us into trying to find one of these companies to, I don't know if you call it bottom fishing or not, Hugh, but it's certainly not a conventional pick, certainly non-core. And I'll just close with saying that some of the top performing mutual funds and hedge funds in the nation have had some of these companies. Keep in mind that Bank of America has either quintupled or quadrupled from its lows back in 2009. So how to pick that is a very challenging prospect.
Yeah.
All right.
If I could just add one, this is Cy, one real quick thing. Hugh alluded to it, and that being the fee structure. I have been on a bit of a personal crusade for a while against overdraft fees and banks legalized larceny. I believe that it is in some circumstances. Bank of America was the first bank to stop the most abusive aspect of that, and has taken somewhat of a near-term hit. And actually, their policy goes well beyond that required by the Credit Card Reform Act. And so just kind of it from that both impacts their current revenues because the number of overdrafts by the average account, it was astronomical when I looked into it. I think it's about 19 a year for the average account, and when you multiply that by a $30 or $35 charge, you can see the dollars that people are paying. But in any event, that's out there, and Bank of America is not collecting much of that now. On the flip side, however, because they started their policy, they may have taken the hit earlier than potentially other banks that are now at least less able to continue some of those charges. Consumers can, quote, opt in to the privilege of having the bank charge you $30 for overdrafting your $5 hamburger at McDonald's. Bank of America doesn't do that at all. They don't do the opt-in, but of course, if you don't opt in, the other banks can't do it anyway. So if you believe anything along the lines of doing right, doing well by doing right, Bank of America has at least a little bit of that going for them.
Yeah, I could definitely see that. I mean, I've personally been aware of that type of. They collected a lot of fees from overdrafts. There's lots of literature on it, and yeah, that definitely is going to be a hit. So with that, I think we'll just go into the question and answer part of our session. I just wanted to remind everybody that our portfolio is out there as a public and published tracking portfolio, as you can see on your screens right now. That's also accessible from the Manifest Investing homepage. So with that, let's go ahead and see if there's any questions. We'll go ahead and see what's on people's minds. Ken, did anything reach out and grab you so far?
Mark, Bob Shaw has his hand in the air, and I'm going to unmute Bob.
Okay.
Bob, you're unmuted.
Thank you. Bank of America. Bank of America took over Countrywide, and PIMCO and the Fed and Blackstone are all suing them over all this house and mortgage mess and all those lawsuits likely to play out here.
Well, anybody want to tackle that one? I would just put in a nutshell say that Countrywide is definitely a challenge and an opportunity to do better for Bank of America. Hugh, do you want to tackle the lawsuit end of that, or Cy? I'm hearing silence.
I'll just echo your comment. It's a challenge, and interestingly, along the lines of what Hugh was saying, while Countrywide certainly is a potential legal liability, what we've seen in the mortgage foreclosure area pretty much across the board the last couple of months may equalize the lawsuit-oramas a bit, although slightly different reasons and different scale, but it looks like just about all the players are going to be involved in legal action.
I'll just pick up on that.
Arising from the housing
I don't
mess.
I don't think any one of the four of us would consider Bank of America to be a core holding, and as such, perhaps it will become a core holding someday in the future. Who knows? But right now, it certainly is a company that is fraught with challenges. It's certainly one that Hugh McManus and I have had many conversations about the notion of, especially for an experienced investor, risk capital. A risk capital portion of your portfolio. And I have a hunch that Hugh would put Bank of America in his risk capital part of his portfolio. So, and you definitely think about it and bring that to the party for sure. Okay, I think we did run a little bit long, but we also started a little bit late. I just want to say thanks to my colleagues, Ken, Cy, and Hugh. Thank you for your contributions, and then again, give a shout out to Dan Hornick over there in Wisconsin, our producer. Thanks very much for the volunteer work that you do. We certainly appreciate that, and hope that all of you have enjoyed this. We'll be back about a month from now, and probably be in the Thanksgiving spirit about then. But we'll let you know. Thanks, everybody.
Bye.
Be good to those trick-or-treaters out there.